Hey guys, welcome to Mindful Investing. This is Sean. Today I want to talk about stock market. As you all know, all these three major indexes, Dow, S&P 500 and Nasdaq has been trading all-time high, and even the futures looks, brighter, it's going up. I just took this screenshot, just in a few minutes ago, and today is August 23rd, 2020, Sunday, and tomorrow is Monday. Seems like stock market will again close all-time high tomorrow. But you know, being in the market for more than 7 years and having some experience around the market, I feel like there are three compelling reasons why I think stock market can crash again. This is my personal opinion, and just don't take it as a financial advice. So do your own research. And here are my three reasons. The first reasons: insane valuations. You all know there are like a lot of stocks in the stock market that has high valuations right now, and especially this Apple and Tesla, which has gone up massive in last few months, right? And majority of the prices has gone up just after the stock split announcement, right? Tesla announced the stock split back in August 11. They announced 5-to-1 stock split, and Tesla stock surged 7% right after that, and then it has gone up and up. I think it has gone up maybe 30% since then. And look, and similar to that, Apple announced back in July 31st, and stock has been going up since then. It does not make sense because stock split is nothing but just dividing the existing shares into tiny shares. Is similar to like cutting your one pizza into 5 different pieces, or 6 different pieces. It does not increase the amount of pizza, so it does not really make sense. And look at Apple's valuation. It is like highest, it is most expensive, most valued company in the world right now, because its market cap is 2.127 trillion. And look at the volume. The volume is almost 2 times the average volume. So there are a lot of trading going on in these stocks. And just be mindful, Apple is around like 10 to 15% of the major index like S&P 500 and even Nasdaq. So if the stock prices drops on these highly valued companies, the major indexes can do definitely an opposite swing. Basically it can drop huge, and it can also drive the market lower. Look at the Apple, the valuations, like PE ratio, which is extremely high right now. It's around trading 35, close to 40 PE ratio. Looking at the historical PE ratio for Apple, it has never been that high, until 2008, right? So it made sense to have that valuations back in 2008 because of the new iPhone announcement, which was game changer for the Apple. But since there was no any game changing product announced by Apple, having that company valued in this much is really insane. And look at Tesla as well. It is trading near 400 billion valuation, and even the volume is also up compared to average volume. And look at the run stock chart. Back in June 1, 2010, it was trading. It is still not visible in the map, the graph itself. Right now, it is trading, around 2,000. It's crazy up. And you look at those, graph from last year. It is just going up and up and up. Seems like there is no end. But look at the PE ratio, insanely valued. Tesla has been profitable last 4 quarters now, but most of those profit came from the environmental credits. They didn't produce more, significantly more vehicles, and had more profit from the vehicle production, but it was just mostly from the environmental credits, and that cannot solely drive the growth of the stock, so, and the company, right? So just be mindful of not only those two stocks. There are like a lot of other growth companies, like for example June, which is also trading high right now, and Shopify. Those are just few names that came to my mind right now. And look at the forward P ratio. Looking at the forward P, it is, the valuation is not that crazy high because it has been trading around 200 P ratio in looking at the last few quarters. But still, it is a high valuation for the company. So we can tell the market is evaluating some of this company high, trading rich. So just be mindful. We just need to be mindful of this, and we should all remember, what goes up will come down sooner or later. All right. So second reason, investor psychology, right? Psychology is not one of the least talked thing in the stock market, because it is boring maybe, but psychology is a very most important thing for the market and for the investors, right? The reason is, if like certain people are bearish, they have they feel like stock market will crash, they might share those emotions to other folks who are in the market, and it might create that ripple effect, and it can cause mass panic, that like we had back in March. So psychology is really important. And in psychology there is like two main elements in investing: greed and fear. Whenever there is greed, stock market will go up and up and up, and whenever the fear kicks in, markets will go down, right? That is very basic greed and fear scenario that you all know. And one other thing is, we have a lot of new investors and traders, and their psychology is, I would say not robust enough to handle a lot of volatility in the market. And a lot of these new traders just got in after the March crash, and they don't know the feeling like losing money, and they might get crushed, right, in some of those highly valued stocks, and they might lose money. They don't know about it right now because they have not experienced it. And it is similar to learning swimming. If you just watch somebody doing swimming on the pool, you cannot just learn just watching somebody else swimming it, or watching videos, right? People do swimming it. You have to jump into the water, and that's how it works. And then the good thing is, we have a lot of new investors. Not all of them will lose money. There will be some who will lose a lot, and they might hit the market. They will not come back it again, but some of the folks will stay on, and that's good for the market. And current fear and greed index is near extreme high. Not that high, but it might get that extreme high greed in the future. So looking at that, stock market can go maybe 5 or 10% from here. I mean, who knows? But 100% from here, is extremely impossible to think about. And also maybe 50% from here is almost impossible. And whenever there is a fear, extreme greed, the fear kicks in, it might take the market down and down. And third reason, that is second wave. I mean, right now we don't have that much concerns, in the market about second wave. Yeah, because everybody is getting used to wearing masks. Everybody is thinking this is the new normal. And and looking at the new cases, it is basically going sideways right now. In daily death also going sideways. But this is summer. What happens in the winter? We have a seasonal flu which has similar symptoms like coronavirus, right? So this is important, because let's say we have thousands of people who have seasonal flu and they think they have coronavirus. They will start panicking, and they can go to hospitals. And you know the the panic can replicate, similar to a smile that is contagious. The panic is also contagious, right? One person is panicking, other person might get it. So just be mindful of that. And the other thing that happens with the panic, and that if the numbers really go up in the winter, lockdown will happen again. And that's not really good sign for the job market, because unemployment is already all-time high. I mean, less than all-time high, but still, that's a crazy number. 10% unemployment, even with these stimulus packages that government has implemented. This is high number. And the winter is almost there, like within few months. So if the numbers goes up and there is another shutdown, this unemployment number would spike again. Maybe it might cross the previous unemployment number, right? So that is really scary, and that might create a lot of panic in the market. Who knows? And it might crash again before 2020. So what do you do? How to get ready for that? If the second crash comes, right? The first thing is have money on the side. I always recommend whenever you are not comfortable with the market, just have about 10 to 30% of cash of your portfolio, so that whenever there is a dips comes in, you can find really cheap companies where you can buy, and can maybe basically adjust the risks. Second thing you can do is, out of many stocks in the stock market, there are some which are unpopular and fairly valued or undervalued. So you can find those stocks, hold into it. That might also help you limit the drawdown whenever the market crash. And third is, you can stay vigilant about the stocks that you are picking. Don't buy into the hype. Don't buy into somebody who is just recommending. Just do your own research as well, because at the end of the day, the person who recommended the stock might not be around you, right? And you are the one who will be making decisions, and most importantly, it is your own money. So just be vigilant and learn about the market, learn how to read the balances, learn how the market works, how the market reacts certain news. That is really important. Stay vigilant. All right, so that's what I think. What do you think about the my opinions? Please write on the comments below. And if you like the video, please hit the like button. That'll help my channel. And please subscribe to my channel as well. And hope you have a nice day. See you until next time. Take care.